If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. The Philippines in Q2 2025 faced a mounting fiscal burden and elevated interest rate environment, which together pose serious constraints on growth and policy flexibility, a combination that arguably constitutes a debt-related crisis in all but name. On the debt side, the government debt-to-GDP ratio reached about 60.70% in 2024, and forecasts show it rising toward around 61% by end 2025. On the interest rate front, although mainstream commentary often emphasizes rate cuts, achieving credible lower financing costs remains challenging. The central bank's key target reverse repurchase (RRP) rate was reduced to 5.25% by June 2025, but many firms and borrowers still face considerably higher effective interest burdens due to spreads, currency risk, and legacy debt. At the same time, GDP growth, while positive at 5.5% year-on-year in Q2 2025, is down from earlier highs and falls short of what might be required to meaningfully reduce debt ratios or absorb higher financing costs. In Q2, the Philippines faced a growing policy space crisis. Despite adequate headline growth, a combination of high debt, elevated borrowing costs, and insufficient job creation has put the economy in a precarious holding pattern. Let's look at the numbers. The national debt burden sits at roughly 61% of GDP. While not a solvency crisis, it severely limits fiscal headroom. With GDP growth at 5.5%, the economy is falling into a trap where growth is insufficient to lighten this debt load, especially as the fiscal deficit remains around 4.6% of GDP. On the interest rate side, although the policy rate was cut to 5.25%, effective borrowing costs for many firms remain much higher. This high cost of financing constrains investment and hiring, retarding growth further and making the debt burden stickier. This directly impacts jobs. The unemployment rate rose slightly to 4.1%, and persistent underemployment signals that the economy's capacity to absorb labor is weakening. Meanwhile, low inflation of 1.4% reflects weak demand and does little to erode the real value of debt, compounding the problem. This creates a vicious cycle. High debt and interest rates slow growth, which in turn makes it harder to service the debt, reinforcing the trap. The economy is growing, but not strongly enough to reduce these imbalances. In policy terms, Q2 creates a difficult trade-off. Cutting interest rates more aggressively would help stimulate investment and hiring, but with debt high and inflation, albeit modest, still above zero, policymakers must tread carefully. If the central bank eases too much, while inflation or currency risks build, interest costs may rise. Fiscal policy is similarly constrained, with debt at 60.7% and deficits near 4.6% of GDP, large stimulus risks increasing debt further and raising rollover risk. Thus, the crisis here is one of limited policy flexibility rather than imminent default. Yet in Q2, it becomes visible and tangible. To summarize the key figures for Q2 in the high interest and high debt framing: debt to GDP around 60.7%, policy rate around 5.25%, though effective financing rates higher, GDP growth around 5.5% year-on-year, unemployment around 4.1%, inflation approximately 1.4%. The combination of these suggests that growth is positive but not strong enough to significantly reduce debt burdens. Borrowing costs remain high relative to growth potential. Unemployment is modest, but rising. Inflation is low, which further limits relief for real incomes and debt erosion. Together they define a debt interest crisis in Q2, rather than merely a cyclical slowdown. In conclusion, the Philippines in Q2 2025 displays the hallmarks of an economy under strain: relatively high and rising public debt, elevated effective borrowing costs, moderate growth that fails to ease structural pressures, and a labor market that is not absorbing slack sufficiently. The term debt crisis and high interest rate is appropriate insofar as the economy faces a policy constraint trap. High debt limits stimulus, high borrowing costs limit investment and hiring, and moderate growth keeps job creation weak and debt burdens sticky. Unless strong acceleration in growth occurs, interest costs fall materially and structural reforms raise productivity, the Philippines risks prolonging its debt interest burden and labor market challenges in coming quarters. For Q2, the Philippines faces a narrative of high debt and high interest rates. Debt is high, growth is too moderate to erode it, and effective borrowing costs remain elevated. This isn't a solvency issue, but a crisis of policy space. With GDP growth at 5.5%, the Philippines is falling into a trap where growth is insufficient to lighten the debt load, which now sits around 61% of GDP. On the interest rate side, while the policy rate was cut to 5.25%, effective borrowing costs for many firms remain much higher. This high cost of financing constrains investment and hiring, which retards growth further, making the debt burden stickier. This directly impacts jobs and incomes. The unemployment rate, now at 4.1%, is rising, and underemployment persists, signaling that the economy's capacity to absorb labor is weakening. To summarize the key figures for Q2, debt to GDP is around 60.7%, GDP growth is 5.5%, unemployment is 4.1%, and inflation is approximately 1.4%. The combination suggests growth is positive but not strong enough to reduce debt burdens. In conclusion, the Philippines in Q2 2025 displays the hallmarks of an economy under strain: relatively high public debt, elevated borrowing costs, and moderate growth that fails to ease structural pressures. In conclusion, the Philippines in Q2 2025 displays the hallmarks of an economy under strain: relatively high and rising public debt, elevated effective borrowing costs, moderate growth that fails to ease structural pressures, and a labor market that is not absorbing slack sufficiently. The term debt crisis and high interest rate is appropriate insofar as the economy faces a policy constraint trap: high debt limits stimulus, high borrowing costs limit investment and hiring, and moderate growth keeps job creation weak and debt burdens sticky. Unless strong acceleration in growth occurs, interest costs fall materially, and structural reforms raise productivity, the Philippines risks prolonging its debt, interest burden and labor market challenges in coming quarters. Taken together, Q2 shows debt to GDP around 60.7%, a policy rate around 5.25% with higher effective financing rates, GDP growth near 5.5%, unemployment around 4.1%, and inflation approximately 1.4%. Put simply, debt remains high, borrowing costs are elevated for many, and growth is insufficient. A policy space crisis more than imminent solvency risk. Policy choices are constrained. Cutting rates could stimulate investment but risk currency and inflation pressures. Fiscal stimulus may worsen rollover risks with debt already elevated. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.